Good morning, everybody. This is the live market open for March 22nd. I'm Yohay, Elam, Forex Conscious Market Movers podcast, doing the show as usual for FX Street. Hello, everybody. As usual, we'll cover recent developments in markets, cover charts and levels. We'll have our technical segment now that the dollar is, of course, much lower. We'll discuss the upcoming events for this week and for next week. And our currency of the week is pound dollar. And then we'll wrap up the show. We have lots of things to talk about. Your questions, of course, are always welcome. If you cannot see the chat box alongside the screen, please go to the address here, tlk.io/fxstreet-forex-live-video. Okay. So, lots of headlines. Basically, the most important thing that we're talking about is that the US dollar is still licking its wounds from the Fed decision. Okay, the Fed made its dovish hike. We'll get into details later. We're seeing the dollar fall. We're now seeing also stock markets fall. This especially helps the yen. Moving to the euro, Macron, after the first presidential debate on Monday, he had a successful performance there. He's the centrist, the former socialist, the young candidate. He is leading the polls also in the first round against extreme right candidate Marine Le Pen, leaving Francois Fillon and the other candidates far behind. Okay, that's euro positive. Another euro positive thing that happened mostly last week was that the ECB went a bit hawkish. So a few members began talking about perhaps raising rates before ending the QE program, at least raising the deposit rate, not the main lending rate. The Dutch elections held last Wednesday, just around the Fed decision. They were also euro positive. It's quite a mess in Netherlands, but at least the far-right candidate came out second and not first. Moving to Europe, to the UK, which is leaving Europe, and that will happen on March 29th when the UK will officially table Article 50, the clause in the Lisbon Treaty that allows the Britain to leave the European Union. Then this 2-year clock will begin ticking down until the exit, of course. That's when negotiations officially begin. I'm sure there have been some negotiations behind the scenes. And we had over the weekend a G20 summit, not of the leaders, but of finance ministers and central bankers. The United States is a bit drifting away. United States Treasury Secretary Stephen Mnuchin, he had a different opinion in comparison to his colleagues. He wants fair trade, not rules-based trade. And it seems there's a disagreement over there. And oil prices remain low, but they have stabilized. Okay, let's talk a bit more about the dovish hike. So last week, the Fed made its word. We had the Federal Reserve raising rates exactly as expected, okay? That was no big surprise. They gave us all the thick hints. We talked about it several times. We had Dudley Brainard and, of course, Yellen herself saying that they will raise rates barring any disaster. The NFP was okay, and we went for the third rate hike since the financial crisis. But this rate hike came in March, just 3 months after the previous rate hike. Now, in pre-crisis years, having a rate hike every meeting during a tightening cycle is, of course, very normal. But since the Fed prepared us for a full year until the December 2015 rate hike, then took another full year to raise rates again in December 2016, suddenly they accelerated the pace. What's going on? Markets thought, okay, now it's going to be a higher pace because the economy is moving faster. All the forecasts are looking better. And the answer is no, absolute no. It was a dovish hike. As I see it, the Fed took the opportunity to raise rates because the stock markets were, at least last week, they were high. Markets were focused on other things. It was a good time to sneak in a rate hike now and let things develop later on. Because if you look at growth figures, they're not so exciting, not so impressive. And so it seems that they wanted just to bring this rate hike forward. It isn't a change. They didn't change the outlook, okay? They didn't change the outlook for rate hikes, any of the forecasts. Yellen said that they're getting closer to a neutral rate. So this hike basically brings them, like any hike, brings them closer to the end of the tightening cycle. There was one dovish dissenter, Neil Kashkari of the Minnesota Fed. He inherited Naranya Kocher-Lakota, which was also quite dovish, and Kashkari went on television this week to explain why he was dovish. He said basically there's no justification for rate hike. And of course, regarding the US dollar, we've also seen a buy the rumor, sell the fact. Okay, we were told about this and we had no new hawkish stuff to rely on for further moves. So here we are, 1 week after this rate move, and we're still seeing a weak dollar. Okay, that was the big event last week. I wanted just to cover that. If you want more details, I had an article on Forex Crunch about the 5 US dollar downers, all these 5 reasons detailed. Okay, let's continue. Moving to the Netherlands. Here we can see on the left Mark Rutte and on the right Geert Wilders. So Rutte, his Liberal Party got 33 seats in the parliament. Now it's a 150-seat parliament, so he'll still have to cobble up a coalition. There are 13 parties in parliament, but what is important for market is that the extreme right candidate, Geert Wilders, got only 20 seats. That means he was left far behind, and that means that the attention is now moving away from, well, already moved away from the small country, relatively small country of the Netherlands, to back to France, which is the main deal. Okay, so that gave the euro another boost last week. The hawkish tilt from the ECB, Novotny, he's the Austrian member. He sees the hike of the deposit rate. Other members like Peter Pratt and Visco, Pratt is Belgian if I'm not mistaken, and Visco is Italian, they sounded optimistic about the economy, the end of deflation, and also lowering stimulus. And we'll have to wait for June, to the June meeting, which is far away from now, until we get more data, more details, if they're really moving towards the exit, but at least they're sounding a bit more hawkish. Also, the Bank of England, in its rate decision, I think it was in the same day, on Thursday, they were also a bit hawkish. We'll get into that more in detail in our currency of the week. But this lady here, Christine Forbes, she voted for a rate hike. Others also considered that. The Bank of England is a bit uneasy with the weak pound. That raises inflation. We've seen inflation figures rising. Let's talk a bit about the data also in the United States. Well, in the United States, inflation was already not that low, and it remains stable, 2.2%. Also, retail sales were looking good, not on the figures for February, but actually on upwards revisions for January. So all in all, solid core data. It was okay, but it doesn't help. These data points do not help the US dollar at the moment. Other figures, US housing was mixed, jobs was okay. All in all, the labor market is looking good. That's why the Fed raised rates. Consumer sentiment is up, but not exciting. And industrial output, what Trump cares about, manufacturing is flat. Elsewhere, so here's what's going on in the UK. So on one hand, well, real incomes are basically almost flat. Okay, so the jobs report, which was okay in terms of changes in jobs, showed that wages are rising at a pace of 2.2%, and inflation now rises at 2.3%. So this doesn't look good. The wages are for January and inflation is for February, but all in all, real wages, what UK workers can do with their money, that's losing value. Okay, so that's a point of worry. The standard of living in the UK is falling. Again, we'll talk about that more in detail later on. New Zealand GDP disappoints with 0.4. On the other hand, milk prices rise 1.7%. We have rate decision in New Zealand later today. I don't know how many of you are trading this currency. In Australia, a more popular currency, a jobs report disappointed with the loss of over 6,000 jobs and the rise in the unemployment rate to 5.9. In Canada, oil prices stopped hurting the Canadian dollar, and retail sales gave another boost. Yesterday, we had the data, and it came out better than expected. So lots of news. We covered lots of news. The main theme is the US dollar demise, the fall of the greenback. And now let's begin looking at the charts. So this is our technical segment for the major pairs, support and resistance lines. Today it's March 22nd. We're away from the Ides of March, and as we said, well, let's take a quick look here at the Japanese yen. It's falling below this triple bottom. Let's zoom out again today from the Japanese yen, because it often reflects, best reflects the changes in the US dollar. So, and it has also an interesting technical pattern here. So dollar yen is now falling off this triple bottom that you can see here at 111.60, currently 111.30. Trading towards the lows. Again, the safe haven currency also attracts flows. The stock markets are falling. Next support 110, very round number, more of a psychological number than anything else. It's followed closely, well, not so closely, sorry, by 107.50, and then we have only 105.50. Anyway, we're trading at low last seen back in November, okay, around the US elections. To the top side, we have 112, 112.50, and 113. So it's quite busy up there. Actually, we're falling off the recent range seen since the beginning of the year. Okay, correlated with stock markets. Euro dollar is a bit higher, getting very close to the highs of the year. So the highs of the year were 108.30, seen in late January, early February. It's followed very closely by 108.70, which was seen. Which was the high of December. And then we have, of course, 110 and 113, which is far, far above. That was on election night in the United States. To the downside, we have more familiar levels from recent weeks. We have the 107.60, 107.15, 106.80, and 106.30. Okay. Anyway, it's quite an upwards move again, fueled by Macron and the ECB's hawkish tilt. Pound dollar, the beaten pound. Brexit is coming in 1 week, but again, high inflation and the weakness of the US dollar push it higher. Here we are, 124.77. We already crossed the 125 level this morning. 125 is a very round number, but not resistance. I see resistance at 125.60, okay, which was a high in late February, and then it's followed by 126.75 and far above 127.90, the initial post-Brexit low. To the downside, 124.15, 123.40, and 122.50 are lines to watch. Not that long ago, actually, last week we traded, flirted with the lows of 121. So we talked about euro, the pound, the yen. Let's talk about dollar CAD. Here we are at 133.66. So dollar CAD moved higher earlier last week. 2 weeks ago, reached 135.40, line of resistance. This is followed high in the sky with 136. Lower we have 134.60. Current resistance 133.80. We're getting close to that number. Commodity currencies are not celebrating against the dollar as much as major pairs. And lower we have 133 and 131.80 as well, before the very round number of 130. Moving to the Aussie. Aussie, we had for quite some time a range here of 76.10 to 77. We fell below this range, flirted with the 75 level. Thanks to the Federal Reserve, we went back up, and actually we have challenged already the next resistance here at 77.50. Now we're back to the downside. Anyway, the range, we're back to the very familiar range of 76.10 to 77. The Kiwi. Kiwi is struggling here exactly at this pivotal line of 70.40. Further resistance 71 and 71.35. To the downside, we have 69.50 and 68.80. All right, so these are major pairs for March 22nd, the technical segment, support and resistance levels. Now, let's continue to the crosses. All right, so this is our technical segment for crosses, March 22nd. Let's begin with Euro Swiss 107.12 is the level here. Last week we had a decision by the Swiss National Bank. Basically, they didn't change anything. Not worth wasting too much time on that. 107 is support, 107.60 resistance, followed by 107.50 108.80 and 108.30, which was the swing high seen this month in March. To the downside, we have 106.25 as the bottom line there, bottom of the range, perhaps the line of intervention by the Swiss National Bank. Euro pound, the Brexit pair, 87.80 is, well, remains tough resistance. It's followed even higher by 88.50. To the downside, we have current levels around 86.50, and then if we move lower, we have 85.75, 85, and 84, which was seen, I would say it's the low of March. If we go even further below, we have 83.30, which is a veteran line here in the Euro Pound chart. Euro Yen, 120.30. So we're seeing how these safe haven flows support the Japanese yen, also against the euro. So 120 is, of course, support. Very, very, very round number. 118.50 is the next line, followed by 118.15, very close over there. Even lower, we have 116.25. To the upside, we have 121.30, which was the high in during February, and 123, a recent high. The Dragon pound yen, surprisingly stable if we compare it to other crosses, and especially given the nature of this cross known as the Dragon. So it's confined to a range of 138.60 to 140.50, so only 200 pips for this usually very, very volatile cross. Further above 142, 142.80 and 144.80. To the downside, we have 136.40. And as usual, we're adding oil to our crosses segment. So quite a big collapse here in the price of oil about 2 weeks ago. Currently, we're standing at 48. The current range is 47 and up to 49.50. In WTI crude oil, 50 is a symbolic number, but not a technical level. Further lines to both sides, 44.50 to the downside, last seen last year, before the OPEC meeting, and then 42. To the top side, we have 52, which was the double, triple top resistance line, and 55.20. All right. So that concludes our crosses. And now let's continue by talking about the upcoming events this week. Still a few things to go. Of course, we have echoes from the Fed. We have echoes from the Bank of England, from the ECB. We have stock markets falling and some political news, of course. But in terms of data, today is relatively light. So we have existing home sales in the United States of America. The vast majority of transactions are made for second-hand homes, for existing homes. New home sales are a bit more important as they better reflect the ebb and flow in the economy. And at 8 GMT, we have the New Zealand rate decision. No changes expected from the RBA. Said last time they managed to talk down the Kiwi. I'm not sure they'll be that successful this time. So, GDP is lower. They could express worries about that. But the Kiwi already fell quite a bit, and milk prices are up. So I'm not sure they can have much leverage anyway. Watch out for the Kiwi battling the 70 level, very round number over there. On a Thursday, tomorrow, UK retail sales, very important, because in recent months we've seen retail sales in the United Kingdom drop. That's because of higher prices. Higher prices stem from the weaker pound, which is of course a result of Brexit. Now, we'll have to see if this trend continues, and especially if Brits continue stocking on essentials, which means food and energy, things that you cannot live without, and buying less non-essentials, okay? Let's see if this trend continues. It could be a sign of worry that the economy that so far withstood Brexit in quite an impressive manner, I must say, much better than I had expected in the third and fourth quarters, which were immediately after Brexit. The economy grew by about 0.6% quarter over quarter, quite solid growth. So this might not last for too long. And tomorrow we also have the weekly jobless claims in the United States, but the main event tomorrow is a speech by Fed Chair Janet Yellen. She might skip monetary policy altogether, but I think that there's a good chance she will be speaking about that. So her other colleagues are also speaking. They spoke out this week, and they'll continue speaking also tomorrow. So let's see if she goes more to the dovish side, or the dovish hike, or talking again about raising rates rapidly, like some of her more hawkish colleagues. I have no bias towards what she'll say. I think so far the weaker dollar serves them, but maybe it's enough for now. Anyway, we have her speech tomorrow. It's not a testimony. It's not a post-rate decision speech, but still of importance. So tomorrow we also have new home sales. Again, a minority of sales are of new homes, but they're better correlated with the economic cycle. We have Neil Kashkari, which already gave TV interviews and did a Twitter session, Ask Me Anything. Think he'll be talking again. He's a known dove and very outspoken. He has very good arguments why he dissented and why rates should not rise. On the other end of the spectrum, we have Kaplan, another Fed member, speaking at 11 GMT. On Friday, we have Eurozone PMIs between 8 and 9. The most important one is the German manufacturing one. We seem to have a bit less impact, and the Fed speakers continue. And let's say on Friday, with Charlie Evans of the Chicago Fed. He used to be a dove, but not so much anymore. And the most important economic piece of data comes on Friday from the durable goods orders in the United States. Watch out for the core numbers, which reflect a long-term investment. Okay, and for those trading the Canadian dollar, we have inflation. So I would say this week is warming up. So most events come on Thursday, and also some interesting stuff on Friday. So far, we had quite a few movements without economic indicators. I'm sure we'll see even bigger ones. Yellen is the most important event. Her speech on Thursday in the wake of the US session is the most important event for this week. And now to our currency of the week, pound dollar. God save the Queen. Brexit and Trump, the gifts that keep on giving, providing us with quite a few movements on the charts. But of course, it's not only the political events. There are other things that move the currency. So I chose pound dollar as the currency of the week because we finally have a date. A stronger Britain. The UK is going to leave the EU, make the announcement officially on March 29th, 2017. And this actually ticks the clock back down, begins the clock ticking towards 2019, 29th of March 2019, because according to Article 50 of the Lisbon Treaty, there are 2 years to negotiate a deal. Hopefully, there will be some kind of a transitional deal, but maybe not. The EU is, of course, prepared. Theresa May told us that they'll trigger Article 50 by the end of March, and March 29th is certainly meeting the deadline. Okay. But the EU, there were reports that they want to begin negotiations only in June, which is taking their sweet time. And the European Union is bigger, okay, than the UK, so it has more leverage, and they want to deter other members from leaving the European Union, from leaving the Eurozone. They want to show that Britain that it's worse being outside than being inside. They can't get a good deal if they are outside, okay? But all this talk, at least the beginning, could be just the initial position. Everything is negotiable, and this drama will unfold initially now, and then, well, it could last much more than 2 years. And of course, there are lots of other aspects here: Scottish independence, border with Ireland. Let's talk a bit about that. But the main issues are immigration and trade. So here on the top, you can see the European side. We have Guy Verhofstadt, Belgian, and Donald Tusk, Paul, and they're sort of leading the Brexit talks on just a second, here we are with the bigger screen. On the European side, on the British side, we have David Davis and, of course, Boris Johnson, the unforgettable face. They're part of the face, of course. Many things will come down to Angela Merkel, the new French president, and Theresa May, so the leaders, of course. Basically, the UK wants more migration control, taking back control, but to have free trade. The EU says everything or nothing. There are 4 freedoms in the European Union: either or open your borders to trade and people, or close the borders. So these are sort of the very generic stances. EU nationals in the UK and UK nationals in the EU. I live here in Spain, and there are lots of Brits here. Currently, they are bargaining chips in the negotiations. Their future is quite unknown, and I think everybody will pay a price for this uncertainty. The EU could put some kind of a divorce fee on Britain. Britain has obligations to pensions in the EU and other stuff. So things could get quite ugly quite soon. Hopefully, eventually this is part of the negotiations, and there will be some positive outcome at the end. An immediate result of Brexit, as we all know, as we talked about, is weaker pound. Here's one of the tabloids saying, "Take a bow, Britain," just after the referendum. So inflation, as we learned this week, leapt to 2.3%. Okay, higher than expectations. Brits are buying more essentials, less non-essentials. This is bad for the economy, that people are focusing more on survival, if to put it in an extreme manner, and less on luxury. To emphasize the point, real wages are slowing and grinding to a halt. Okay, the unemployment rate is still low, so the economy is still doing well, still growing quite nicely. And the Bank of England has a dilemma. Should they raise rates to stem inflation? How will that happen? If you have higher interest rates, you'll have more flows into the UK to enjoy these high interest rates, and the pound will rise. The pound will rise. Imports will become cheaper, and Brits consumption will be more favorable for Brits. Inflation will fall. Okay. So, but that would be also a problem for the Bank of England, as there would be a big reversal after the August rate cut, immediately after Brexit, a move that was seen, in hindsight, and also some saw it at the time as panic. This uncertainty could hurt demand. Of course, if you raise rates, you also hurt demand. Loans become more expensive. The Bank of England, like many other banks, they're not so special. They prefer to talk and not to act. So what we've seen last week with this hawkish tilt, with the vote of Christine Forbes, with other members talking about reducing stimulus, that's talk that lifts the pound and doesn't force them to raise interest rates. So here's Mark Carney in a sad moment in Parliament, or at least a mellow face. He's stuck between a rock and a hard place. He's likely to talk up the pound in future interventions, in future speeches, testimonies, you name it, interviews. And I don't think they're really ready to raise interest rates. I think maybe even they sent Christine Forbes to vote for a rate hike to push the pound higher, and not to and they don't really mean to do it. It's only talk. Okay, and if we're talking about pound dollar, of course, we need to talk a bit about the dollar. The dollar continues being hit by the dovish hike. We're seeing it this morning as well. No growth, which is a problem, or weak growth. If we have weaker growth, we have no rate hikes down the road, despite them talking about 3 rate hikes this year. It might go down to 2. We have already one behind us, of course. We had it last week. They're now data dependent, not Donald dependent. Okay, everything depends on the Fed. The Fed depends on the data. Donald Trump, now his priority is Trump care. Okay, I think there's a vote tomorrow. According to estimates, many Americans will lose their health insurance. It doesn't move markets that much, but what's important for Forex is that is his priority. So the priority is healthcare, and his budget favors defense, not tax cuts and not infrastructure. These are things that markets want. So he's not moving forward. There's not going to be any fiscal stimulus, or, well, we can always change your minds about that, but it doesn't happen quite yet. And the administration of Donald Trump is mired in the Russian scandal. There's an official investigation underway. The FBI is investigating people in the Trump campaign regarding links with Russia, collusion to impact the elections. We can talk about that for hours, but it doesn't move markets as much as just the fact that fiscal stimulus is not on the agenda. What's on the agenda for markets is the Fed, and the Fed depends on the data. So what's next for pound dollar? We've seen quite a nice rally, okay? I think last time we talked, we focused on the pound not that long ago. It's, of course, a fascinating currency pair. We talked about Brexit trumping Trump, okay? That it's going to sink the pound. Since then, we've been in range and even pushing up within the range, okay? But I think that Brexit negotiations are going to take center stage. They're going to weigh on the British pound, a tough stance by the EU, especially in an election year. Elections are coming in France in April and May, and then in Germany in September. This is going to weigh on the pound. Brexit is still worse than Trump. It has a bigger impact. And the current recovery seems limited. I don't think, again, that the Bank of England is going to raise rates. I think that Brexit will hurt. And the weakness in the dollar, which could last, of course, I don't think it's going to be that painful for the dollar against the pound. Okay, so my bias remains negative on pound dollar. Let's look at the pound to conclude our segment about pound dollar. So we had an attempt to move above 125 or a bit lower, basically balanced on the day. Seems like not moving anywhere fast this morning. 125.70 to be precise is the next level here, seen in the February. Then it's followed by 126.75 and 127.30, and more importantly, as I see it, 127.90, the post-Brexit low, the initial post-Brexit low before we went even lower. Support 124.15, 123.50, 122.50, and 121. Even lower, of course, we have the 120 level, or symbolically, in the middle of January, the level was 1.1985, 1.1985, the year when we've seen these kind of levels in pound dollar. Okay, so currently we're sort of in the middle of the range seen since October, or even higher in this range. But despite all the hawkishness from the Bank of England, I think we have more room to the downside. All right. Let's continue with preview for next week's events. Next week, it's the last week of March, which means that we'll have end of month flows. It's also the end of the fiscal year in Japan. So it's not only a quarter for Japan, it's also the end of the year in financial terms. So it will be quite a mess. There's also a time shift in Europe. We're moving to summertime. So next week, the show will be still at the European Open. That means it'll still be 9 here in the Eurozone, 8 in London, but it'll be 7 GMT, not 8 GMT. On Monday, we have the German IFO business climate. It fell last time, but now it's expected to bounce back. We have consumer confidence in the United States, the CB consumer confidence. I think that the University of Michigan measure has more impact. On Wednesday, we have German inflation figures, of course, important for the euro if the ECB really goes hawkish. And then pending home sales in the United States and oil inventories. On Thursday, we have Spanish CPI. Again, we have these inflation numbers pouring out of Europe one by one. Dripping would be a better term. Final US GDP, perhaps the most important release. It'll show us how poor Q4 growth was. Remember last year, 2016, we had one strong quarter, Q3, the rest were not that impressive. And of course, jobless claims. And on Friday, the last end of the month, the quarter, and the fiscal year in Japan, we have inflation data from Japan, German unemployment, final UK GDP. We get a reminder, perhaps, the last song of positive UK GDPs. That will be for Q4. We have inflation data in the Eurozone, sort of bringing everything to a conclusion, but watch out for German one. The favorite inflation measure of the Fed, it's called the Core PC Price Index, the one that Yellen and her colleagues focus on Friday, and the Canadian GDP. So lots of GDP data, inflation data from the Eurozone, and lots of end of month, end of fiscal year flows. Okay, so it could be quite a wild week, even though the main figures are concentrated towards the end of the week. Let's take another look at what's going on in markets before we begin the wrap-up. Oh, US dollar is gaining a bit more ground, recovering. The Japanese yen is the main beneficiary. That is, of course, related to stocks. Here we can see the S&P 500. I don't talk about that so often, but it hardly moved in, well, it did move to the upside, but in very gradual steps, and a relatively bigger fall yesterday. Right, time to wrap up the show. This is the wrap up for the live market open for March 22nd. Getting closer to the end of the first quarter of 2017. We're seeing quite a few things in markets. And US dollar is basically on the back foot. Attempts to recover this morning are very poor. Looks like a dead cat bounce. The euro enjoys the fact that Emmanuel Macron leads in the French polls after his good performance in the televised debate. Another point of support for the euro is that the ECB went hawkish. Okay, they are contemplating raising rates even before the end of QE, something that seemed unreal in the past. And also the Dutch elections last week support the euro. In the UK, Brexit has a date, March 29th. That's when the hard part will begin. The Bank of England, though, is going hawkish. One member voted for a hike, supporting the pound, and inflation figures were strong. We might get a blow tomorrow from retail sales. Of course, the dollar is suffering the dovish hike, and to run quickly on these things, they made no changes to forecast, including rate hikes. They're getting closer to a neutral rate, and one member actually voted against it. So this US dollar sell-off continues. Another thing to talk about in this wrap up, some important data figures. Actually, data figures in the US were okay. Retail sales, most importantly, but they didn't help the US dollar. And elsewhere, we have basically in the United Kingdom a point that is important to stress. Real wages after inflation are in a standstill. Okay, big things to watch out for. Today we have the New Zealand rate decision for those trading the Kiwi. The big event tomorrow is that Fed Chair Janet Yellen will be speaking. We have lots of Fed speakers now talking. Of course, they didn't talk in the 10 days towards the Fed decision, but now everybody's opening their mouths. And yeah, so Yellen speaks. That's the main event. Also watch out for Kashkari. He has good arguments. And on Friday, durable goods orders is the main event, the biggest data point this week. So to talk quickly about the charts, we're seeing basically, well, main theme is dollar strength, but at the moment there is some kind of a correction. Let's see if it's a dead cat bounce or more than that. Euro dollar 107.60 to 108.30 is the current range. Pound dollar 124.15 to 125.40. Dollar yen fell below the triple bottom at 111.60, still battling this level. Further support 110, resistance 112. Dollar CAD currently 133.80, which is line of resistance. Looking up, we have 134.60 and down 132.80. Aussie dollar between the 76.10 and 77 range, a bit falling right now. Well, let's see if this dollar correction continues. At least against commodity currencies, this risk-off sentiment is positive for the dollar against commodity currencies. Of course, doesn't help the dollar against the safe haven yen. And Kiwi dollar ahead of the rate decision tonight, 70.40 resistance, 69.50 support. Okay, so this concludes the show for today. Thank you everybody for coming. We didn't have any questions today, but of course we'll be here next week, and your questions are more than welcome. Wish everybody a safe and successful day in markets, and watch out for all the indicators we talked about, but also some unknowns such as politics or who knows. And so that's it. So thank you very much, and see you next time. Ciao. Bye-bye.